beginning when I was talking about your many hats, Academy Award winner and junk bond trader. You're also an issuer as well.
They're not all that different.
You're also an issuer. So from your perspective, how's the market as an issuer? I mean, you're on the board of an issuing company.
Well, we vote. I'm on the board of directors of CNH, which has been one of, as Jamie's article pointed out last week, it's been one of the top 5 issuers. And that was driven by the opportunity to refinance the debt. I kept pushing. I've been on the board since 1996, and I've been pushing to refinance the debt when we can and lengthen it when we can, because we are, in the end, a cyclical business. Anything could happen. Now agriculture is in the right cycle, so agricultural equipment. The real question is whether you could have the management to take the money you have to build as many facilities for delivery of equipment that's in demand. But we've been through other times when the tractors and the combines were lined up in the fields, with nobody being able to buy them, and that was just 2007. So it's a very delicate business. So you want to take the defensive position in a company and refinance when the money is there. Now, we paid 8 1/4, and now the bonds are, 5 1/2, 5 1/4. That's okay. The last one we did was, I think, 7 1/4, and it's 5 1/4. That's fine, but we now have our capital structure going out, into 2020, and spread properly, and it also gives us the cash to expand the business in the areas of growth, which are very substantial. So I think the markets are very accommodating, particularly to very large companies. This is an $18 billion company, and the speculation is that we're going to be investment grade, so the spreads are very favorable toward us now, and I think those kind of companies should take advantage of this opportunity to really tighten up the balance sheets to make themselves impregnable, so they can focus on the many operational objectives that we have and are there. Right now, they're there for the worldwide companies. I think, as you were saying, worldwide companies today, there are incredible opportunities, but you do have to be well financed for that, and now is the time to do it. If you're a weaker company, now's the time to do it too, because contrary to many things that people are thinking, it ain't going to get any better. It's going to get worse. And so I think a lot of the companies who are sitting back and saying, well, things would be better for me, it's an ever-ending moment, are missing the point. The big part of the balance sheet picture is that it's the fuel that allows you to operate your company. If you don't have that, whatever opportunities are developed, you're not going to be able to take advantage of them at the wrong time. So now that that piece is in the right time, take advantage of it, even if it's a little more expensive, and wait for your other business opportunity to come, and get yourself right when you can. This might be the last time for some of those companies to get themselves right when they can.
Absolutely.
Well, I think, as I said earlier, for the default risk that faced the nation in 2007 has been remarkably reduced by the accommodative stance of the government and the availability of money that allowed a good portion of the major league potential defaults to be refinanced. That's one thing. And the default situation generally is on a scale so that you have ratios between single B defaults, double B defaults, triple C defaults. There are known historic ratios that operate. But under very high stress periods, what you see is a really greater acceleration of the triple C defaults, and they tend to be big companies, that go fastest, that will happen. In a more normal environment, the Bs and single Bs will have a very much rapidly declining default rate, while the triple Cs will not have that much improvement in their default rate. So you have a fairly defined palette that you're working with in the credit spectrum. What will happen here, so long as you have benign growth, you might say, like a 2% growth is what I think Tom Keene was talking about, then you don't have that high stress environment that will accelerate the collapse of the triple Cs and certainly not the higher grades. So I think the default picture doesn't look too bad in a benign economy. Corporations will do well enough. They're going to have enough cash to get them through. They might not doing great, but they're doing okay. In that kind of environment, you don't have default. Refinancings will be available for the better ones. You might have more debt exchanges for the weaker ones. The recovery rates will be a little better than in a bad market because it's a good market. But I don't think you're going to see a disaster ahead because of defaults. As I said earlier, I think the big risks in the pricing that this market has are these exogenous, unthought of events of massive competitive government financings that are uncertain in terms of their source, of where they're going to be financed from. Add to that an unprecedented amount of real estate loans that have to be refinanced. There's something like $400 billion of real estate loans, half of which are underwater, half of which loans are less than the mortgage. The swirls that will be created by these kind of things might just grab the toe of a weaker business.
On that note, Ken, thank you very much. Before handing over to Lisa Abramovich, my colleague, I'd like to urge you to pick up a copy of the Leveraged Finance Brief and to also interrogate our first panel in the breaks. And please join me in thanking them very much for coming along.